Hi, I'm Luke Lango, and this is Investor Place Quick Picks, where we communicate to you some of the market's best investment ideas in just 10 minutes.
America's #1 stock picker, Luke Lango's Investor Place Quick Picks.
Today, we're going to be talking about a once red hot, now ice cold growth stock that may be one of the best stocks to buy right now. The name? Ontrak, ticker OTRK. Now, if you'll remember, this past Monday, the stock market had its best day of 2021. Every major index took off like a rocket ship as treasury yields stopped surging. The Dow rose about 2%, the S&P 500 rose almost 2.5%, and the Nasdaq clocked in an impressive 3% gain. It was a great day for most everyone except those invested in Ontrak stock. You see, on that same day, Ontrak, a small $500 million health tech company that has been in hypergrowth mode as its telehealth-enabled AI-powered behavioral health treatment platform has gained significant traction in the marketplace. That company announced that it lost its biggest customer. And that revenue growth, consequently, in 2021 would slow from 100% plus in each of the past 2 years to just 20%. Ontrak stock absolutely plunged in response by about 50% in a single day. It was an ugly day, the worst day in 5 years for the stock. Now that's the bad news, but here's the good news. It's not a deal breaker. In fact, upon closer inspection, I see parallels between this situation and when Twilio lost its then biggest customer, Uber, back in 2016. Everyone thought that Twilio losing Uber was the end of the world. Twilio stock sunk, but it wasn't. Instead, it was a golden buying opportunity. Twilio's business has thrived ever since then, and Twilio stock, well, it's risen more than 10x since that bottom. Now I think Ontrak stock is on pace to do the exact same thing over the next few years. Here's why. First, let's zoom out and look at the big picture bull thesis on Ontrak stock. It all starts with the overwhelming economic burden that unmet behavioral health issues have on healthcare providers. Did you know that 1 out of every 5 people every year deals with a behavioral health issue like addiction, depression, or anxiety? Now, that's a tragic statistic, and it's also a costly one. Chronic illness patients, think folks with diabetes, hypertension, coronary artery disease, or more, who can currently deal with behavioral health issues, cost health plans up to 4.5 times more than chronic illness patients who don't deal with behavioral health issues. Mostly because behavioral health issues have a compounding effect on the patient's well-being, which prolongs recovery and/or creates new medical issues, right? I mean, that makes complete sense. If you get addicted to your diabetes medicines, you may alleviate your diabetes, but create an entirely new problem altogether. Therefore, health insurers need to figure out a way to better identify patients with behavioral health issues, treat these patients more effectively, and dramatically reduce their cost basis. That's where Ontrak steps in. See, Ontrak is leveraging big data and AI to help health insurance providers better manage the costs and outcomes of patients with behavioral health issues. Specifically, the company sells its PRE, Predict, Recommend, Engage platform to health insurers. As the name would imply, this PRE platform follows a simple 3-step process. 1. Leverage proprietary AI-powered identification algorithms to analyze patient data and predict which chronic illness patients have untreated behavioral health conditions that could worsen their chronic medical disease. 2, leverage robust clinical and insurance claims data to recommend effective care pathways for those targeted behavioral health patients. And 3, employ a multi-model approach, telephone, video, email, text, etc., to engage behavioral health patients and guide them through their care journey. Through these 3 steps, the PRE platform enables health insurers to not just improve the outcomes of their behavioral health patients, but also dramatically reduce the cost of treating these patients by reducing the chance that such patients aggravate their chronic illness. This usage of AI and data to optimize healthcare offerings is the future, and Ontrak is pioneering that future today. Now, the Ontrak business model sounds great, but more important than that, and more critical to the success of Ontrak stock, this business model actually works. So, Ontrak's AI-powered algos are already doing a great job of identifying patients with untreated behavioral health conditions. About 97% of Ontrak's members have not received behavioral health services in the last 12 months. At the same time, the company's unique approach to outreach and fingerprinted interventions are reaching a new segment of the population. Around 90% of Ontrak's eligible population are not touched by health plan care management programs. Members who go through the PRE platform absolutely love it and swear it works. Ontrak has an impressive net promoter score among members of 74, meaning most folks would recommend it to their friend. And most importantly, and this is definitely the most important, the Ontrak PRE platform does exactly what it sets out to do: reduce the economic burden of behavioral health issues on healthcare providers. Ontrak's customers, which already include big names like Aetna and Humana, have reduced their behavioral health patient health costs by over 50% on average. That's mind-bogglingly impressive. And the data here is just crystal clear. Ontrak's PRE program works. The company is truly leveraging big data to drive big savings for big companies. That's a recipe for success. And this success has shown up in the numbers. In 2018, Ontrak's revenues rose 88%. In 2019, they rose another 134%. In 2020, they rose 136%. Now, revenue growth at Ontrak was supposed to sustain its toward 100% plus pace in 2021. Then the company lost its biggest customer. And now, management is guiding for just 20% revenue growth this year. Wall Street is clearly worried that this customer exit, this big customer exit, is a sign of sustained, dramatic slowdown in the business. And rightly so, right? I mean, after all, this big unnamed customer left for a reason. They were clearly not satisfied with Ontrak, so they left. Now, what's to stop other customers from also being unsatisfied and ditching Ontrak too? That's the fear. But the answer to that question is actually astoundingly simple. As I just said, Ontrak has a breakthrough proprietary technology platform that delivers meaningfully positive economic outcomes for its customers. Sure, it didn't work great for this one customer, but Ontrak's deal with this big customer was not normal, and that's very important. It was not normal. The customer evaluated Ontrak on a provider basis, not a vendor basis, as do all of the other companies, as do all the company's other health plan partners. The customer also only interacted with its behavioral health division and forbid interaction with its medical division, which is also abnormal. Plus, the customer didn't value Ontrak's coaching model, which Ontrak itself and many of its other customers see as a critical component of the PRE platform. So overall, this just wasn't a normal deal, And I don't think we should be looking at this loss of business as representative of the company's entire deal portfolio, especially since Ontrak is re-signing and extending contracts for every other customer in its pipeline. If that weren't the case, I would be very worried today. But it is the case, and as such, I think the fears of a sustained slowdown that are being priced into Ontrak stock are overdone. Now, this situation of Ontrak losing its biggest customer at a time when the company is growing at 100% plus pace reminds me of Twilio back in 2016. Now, let's rewind. At that time, Twilio was a red-hot tech startup offering communication APIs to businesses looking to communicate with their customers. It was a Wall Street darling. Revenues were soaring, and the Twilio stock price was flying high. Then, suddenly and seemingly overnight, Twilio's biggest customer at the time, Uber, left Twilio. The company guided for a huge slowdown in revenue growth. Wall Street freaked out, saying that everyone was going to follow in Uber's footsteps and move communication API development in-house. Twilio stock tanked. Well, so much for that thesis, right? I mean, nobody followed in Uber's footsteps. Instead, everyone used Twilio's communication APIs because they were the best the market had to offer. And building such high-quality products in-house would have been impossible, or at least very, very, very hard and very, very, very expensive to do. Twilio's growth rates rebounded, and Twilio stock has soared more than 10x since the Uber fiasco. Now, I suspect Ontrak stock will follow the same trajectory. Most healthcare providers won't follow in this big unnamed customer's footsteps. Instead, most will continue to use Ontrak's PRE platform because it's built on the best technology in the industry with proven and material economic benefits. Ontrak's growth rates will rebound, and Ontrak stock will soar over the next few years. Are 10x gains possible here? Absolutely. Especially when you consider this is just now a $500 million company, pioneering a breakthrough solution in a $33.7 billion market. Well, that's all we have for this edition of Investor Place Quick Picks. I hope you like what you saw. If you did, please subscribe, hit that notification bell, smash the like button. You can follow me on Twitter. I'm very active on Twitter. A Twitter handle will pop up right about now. Or if you like to read, want some more in-depth analysis, please come over and check us out at investorplace.com, where we do have some of the market's best analysis. Until next time, cheers, and happy investing to all.